Get ready because financial guru Tom Lee just dropped a bombshell prediction on March 14th that could flip the script for everyone. He's seeing a light at the end of the tunnel with tariffs, hinting that the market is gearing up for a rapid comeback. But what does this mean for your investment game? Stick with me, and I'll break down exactly what Tom Lee said, why it's a big deal, and at the end I'll reveal 2 must-have tech stocks for your portfolio before 2025 rolls around. We've just witnessed a major shakeup in the market. Can you believe that less than a month ago, things were booming at all-time highs? Now it feels like we've hit the panic button. Investors are acting like a recession is already here. But hold on, because history has a comforting message. Markets always bounce back. And Tom Lee is convinced that's precisely what's about to happen. Before we dive deeper, make sure to hit that like button, share this with your friends, and subscribe to keep up with the latest insights. Let's aim for at least 300 likes on this video. It would be a huge boost for the channel.
One of your next guests says the markets will find their footing before April 2nd, when the reciprocal tariffs, at least for now, are set to take effect. Joining us now for more is Tom Lee. He is the head of research and founder of FundStrat, also a CNBC contributor. Also joining us, Nancy Tangler, Laffer Tangler Investments, CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high, I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say we're almost 50% pricing in a recession, and we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think 2 other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number 1, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the U.S. I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the U.S. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
Now, let's get into the nitty-gritty. Tom Lee is suggesting that there's a strong chance we'll see a resolution on tariffs within the next 3 weeks. That's a game changer. Why? Because the uncertainty surrounding tariffs is what's been shaking the market. The moment we get some clarity, stocks could skyrocket. And here's a fascinating tidbit. The market seems to be anticipating this. Countries like China, Europe, Canada, and Mexico have actually been outperforming the U.S. market since April 18th. This could be a powerful indicator that the worst is behind us. Here's where things got really interesting for me. Tom Lee drew a parallel between our current situation and the Cuban Missile Crisis back in 1962. We were on the edge of nuclear war, and yet the stock market managed to recover 2/3 of its losses before the crisis even ended. That's a crucial lesson. Markets often move ahead of the actual events. So if a tariff agreement is indeed on the horizon, smart investors are already positioning themselves. Now, let's talk about opportunities. When the market takes a dip, some stocks get hit way harder than they should. Right now, some of the top tech stocks have been unfairly dragged down. But here's the silver lining. These corrections are a regular part of the market cycle. And when the market recovers, these high-quality stocks are usually the first to take off. Historically, tech stocks have significantly outperformed the broader market after major corrections. While equities haven't been stellar since Donald Trump became the 47th U.S. president, as of March 10th, the S&P 500 was down 8.6% since February 19th, and the tech-heavy NASDAQ composite was down 13.4% from its December 16th highs. These downturns create openings to snag shares of fantastic companies at a discount. So let's zoom in on a couple of tech stocks that could become even more appealing if we see a full-blown market correction. We're going to dissect these companies, their recent financial reports, and what they mean for us as investors. Let's kick things off with CrowdStrike Holdings, ticker symbol CRODWD. CrowdStrike has been a major player in the cybersecurity world, revolutionizing cloud security with its advanced AI-driven protection. Did you know that CrowdStrike was founded in 2011 by George Kurtz and Dmitry Alperovich, and one of its early investors was Google? However, a publicized service interruption in July 2024 caused some short-term unease among investors. As of March 6th, CrowdStrike's stock had dropped by 4% over the previous 3 months, including a 26% drop from its peak on February 14th. While some investors are being cautious due to a slightly less optimistic outlook for fiscal year 2026, I believe this dip is a fantastic buying opportunity. Market sentiment might be shifting, but CrowdStrike's long-term potential is undeniable. With the growing need for strong cybersecurity and CrowdStrike's leading technology, this stock still ticks all the boxes for a solid long-term investment. In the fourth quarter, CrowdStrike's dollar-based net retention was an impressive 112%, meaning their existing customers spent 12% more than they did the year before. This is a key factor in their strong revenue growth, which includes surpassing $1 billion in subscription revenue in a fiscal year for the first time ever. What's clear is that CrowdStrike's cybersecurity solutions are among the best in the business, consistently earning recognition as a top-tier platform. Beyond the accolades, the company's strong financials, customer growth, and high retention rates solidify its competitive edge. First, let's talk revenue. CrowdStrike reported total revenue of $3.06 billion, a significant 36% increase from $2.24 billion in fiscal year 2023. Even more impressively, their subscription revenue also jumped by 36% to $2.87 billion, up from $2.1 billion. A 36% revenue increase is huge, especially for a company of this size. It tells us that CrowdStrike is expanding its customer base and growing its business rapidly. This growth is largely fueled by the increasing demand for cybersecurity solutions, as businesses worldwide invest in cloud security to protect against evolving cyber threats. For investors, this level of revenue growth signals strong market demand and shows that CrowdStrike is executing its strategy effectively. Now let's look at profitability. At the subscription level, GAAP subscription gross margin rose from 76% in 2023 to 78% in 2024. Non-GAAP subscription gross margin climbed from 78% to 80%. What does this mean? Higher gross margins indicate that CrowdStrike is becoming more efficient in delivering its services. They're managing their costs while scaling their subscription business. For a company that relies on recurring revenue, this is a very strong sign of financial health. Higher margins typically lead to better profitability in the long run, which is something Wall Street loves. Let's move on to income from operations. The GAAP loss from operations was just $2 million, compared to a much larger $190.1 million loss in fiscal year 2023. But here's the big news. Non-GAAP income from operations skyrocketed to $663.3 million, up from $355.6 million in the previous year. This is a game changer. Last year, CrowdStrike was losing a significant amount of money on operations. Now, they're essentially breaking even on a GAAP basis and are highly profitable on a non-GAAP basis. This indicates that the company is optimizing costs, improving efficiency, and successfully scaling. For investors, this is a major positive sign that CrowdStrike is moving towards sustained profitability. Now let's get to net income, the bottom line. GAAP net income flipped from a $183.2 million loss in 2023 to an $89.3 million profit in 2024. GAAP earnings per share, or EPS, went from a loss of 79 cents to a positive 37 cents per share. But wait, it gets even better. Non-GAAP net income soared to $751.8 million, up from $368.8 million. Non-GAAP EPS jumped from $1.54 per share to $3.09 per share. This is an incredible turnaround. The company has gone from losing money to generating profits, and EPS has more than doubled on a non-GAAP basis. For investors, this means CrowdStrike is no longer just a growth story, it's now a growth and profitability story. Wall Street loves companies that can both grow and make money, which is why we've seen CrowdStrike stock performing well. If you're enjoying these stock analyses and finding them helpful, please take a moment to like this video and share it with your friends. Your support helps my channel grow and allows me to bring you even more valuable content. Thank you. Finally, let's look at cash flow, one of the most important metrics for any business. Net cash from operations was $1.166 billion, up from $941 million in fiscal year 2023. Free cash flow jumped to $938.2 million compared to $676.5 million. Free cash flow can be used to invest in the business, pay off debt, and reward shareholders. A 38% increase in free cash flow means CrowdStrike isn't just making accounting profits, but is actually bringing in real cash, something that investors love to see. All right, let's wrap things up. Here are the key takeaways from CrowdStrike's FYA fiscal 2024 report. Revenue up 36% shows strong demand for cybersecurity services. Expanding gross margins indicate greater efficiency and higher profitability. Nearly eliminated operating loss shows that the company is on a clear path to sustain profitability. Turning net income positive indicates a huge shift from losses to earnings. More than doubled EPS is a fantastic sign for shareholders. Booming cash flow shows a strong financial foundation for future growth. Overall, CrowdStrike is executing at a very high level. They're not just growing, they're improving their profitability and financial strength simultaneously. For investors, this makes CrowdStrike one of the most compelling cybersecurity stocks on the market today. What do you think of CrowdStrike's financials? Do you see them continuing this momentum into 2025? But as always, do your own research and ensure it aligns with your investment strategy. By the way, if you're finding this video helpful and enjoying these stock picks, take a quick moment to smash that like button. It really helps this channel grow, allowing me to keep bringing you awesome content like this. Next up is Supermicro Computer with the ticker symbol SMCI. Supermicro Computer, or Supermicro, manufactures servers for enterprise and data center customers. Supermicro is advancing in AI, cloud storage, and 5G edge computing. It has carved out a high-growth niche with its specialized AI servers. Founded in 1993, Supermicro is headquartered in San Jose, California. Early partnerships with NVIDIA and liquid-cooled systems gave it an edge. Supermicro faced challenges with an overdue 10K report but avoided delisting. Analysts predict revenue and EPS growth at 36% and 18% CAGR from FY24 to FY27. Despite recent challenges, its valuation could soar as the AI server market expands. Supermicro pulled in $5.31 billion in revenue this quarter. That's up from $3.85 billion last quarter and more than double the $2.18 billion from the same quarter last year. That's an incredible level of growth, over 125% year over year. So, what's driving this? AI? Supermicro is a key hardware provider for AI data centers, and with the exploding demand for AI infrastructure, businesses are rushing to buy high-performance servers. This kind of revenue growth signals that Supermicro is not just riding the AI wave. It's becoming a major player in it. Next, let's examine gross margins, which tell us how profitable each dollar of revenue is after production costs. Q4, gross margin was 11.2%, down from 15.5% last quarter and 17.0% last year. Non-GAAP gross margin was 11.3%, slightly better but still declining. On the surface, this isn't great news. A declining gross margin suggests that costs are rising or pricing pressure is increasing. But here's the crucial point. Supermicro is aggressively scaling its business to meet record demand for AI infrastructure. This means short-term margin compression, but if they maintain their growth, profitability should stabilize in the long run. Now let's discuss net income, or bottom line profit. Q4 net income was $353 million, down from $420 million last quarter, but still significantly up from $194 million last year. So why is profit down quarter over quarter? Likely due to higher costs associated with ramping up AI server production. However, the overall picture remains very positive. Supermicro is still generating substantial profits, and it's up 81% year over year. If you're enjoying these stock analyses and finding them helpful, please take a moment to like this video and share it with your friends. Your support helps my channel grow and allows me to bring you even more valuable content. Thank you. Now let's break down earnings per share, or EPS, which tells us how much profit each share of the company generates. gap was $5.51, down from $6.56 last quarter, but up from $3.43 last year. Non-GAAP EPS was $6.25, slightly lower than $6.65 last quarter, but nearly double last year's $3.51. This indicates that while profitability dipped slightly quarter over quarter, Supermicro is still massively more profitable than it was last year. Long-term investors should focus on the year-over-year growth rather than quarterly fluctuations because the AI-driven expansion is still going strong. Here's where things get interesting regarding cash flow and debt. Cash flow from operations was $635 million, capital expenditures were $27 million, total cash on hand was $1.67 million, and total debt was $2.7 million. This is a significant red flag. Supermicro burned through $635 million in cash this quarter. A lot of this could be due to higher inventory costs as they scale production to meet AI demand, but investors need to keep a close eye on this. Here are the key takeaways from Supermicro's Q4 2024 earnings. Revenue up 125% year over year. AI-driven growth is explosive. Gross margins declined, costs are rising, but long-term scale should help. Net income is down slightly, but still massively higher year over year. Earnings per share nearly doubled year over year. Profitability remains strong. Cash burn is a concern. Investors should watch this closely. So, is Supermicro a buy? If you believe in the AI boom and data center growth, Supermicro is one of the best hardware plays on the market. But keep a close watch on cash flow and margin trends. Because while growth is great, sustainable profitability is even better. What do you think about Supermicro's financials? Is it a buy, hold, or sell? Tom Lee believes a tariff agreement is on the horizon, and history shows that markets tend to recover quickly once uncertainty fades. This is creating a fantastic opportunity in tech stocks. CrowdStrike Holdings and Supermicro Computers stand out as two of the best plays right now, and if you're a long-term investor, this could be the perfect moment to buy. And if you found this breakdown helpful, smash that like button, share this video with your fellow investors, subscribe, and turn on notifications so you never miss a deep dive like this. Thanks for watching, and I'll catch you in the next one.